I'm Rob Osmond, and this is PwC's Tax Insight in Brief. On July 4th, the federal budget reconciliation legislation was enacted. The legislation features extensions and modifications of provisions enacted as part of the 2017 TCJA that were set to expire or change at the end of 2025. From a state income tax perspective, how states adopt the Internal Revenue Code as the date of enactment and in the future directly affects the application of the federal changes to the state taxable income computation. Therefore, taxpayers should consider Internal Revenue Code conformity, modeling out the changes for the state impact, and monitoring state reactions to the new legislation. First, it's important to understand the threshold state income tax question of whether or not the states conform to the code. States generally begin the determination of federal taxable income by adopting the code in three different ways. Rolling conformity, where they will explicitly conform to the Internal Revenue Code as an effect when incorporated, so for purposes of OB3 on July 4th. Specific date conformity, where they've adopted the code as of a specific point in time, and therefore they're tied to that point in time in the Internal Revenue Code. And code-specific conformity, where they don't adopt the code in its entirety at all, but adopt they adopt certain provisions of the Internal Revenue Code and not the whole code as a whole. There are several parts to the analysis. The federal enactment, a date as of July 4th, the years in which the Internal Revenue Code changes, the state IRC conformity status, and states' updates to the Internal Revenue Code when you're going through this analysis. So now that we've talked about Internal Revenue Code conformity, taxpayers should look at modeling out the impact, not only thinking about 2025, but also 2026. The international tax provisions enacted as part of OB3 are really applicable for 2026, so our taxpayers should be looking at the implications for those states that are automatically conforming. This could impact not only states that are rolling conformity, such as Illinois, but could actually have impacts for states that are non-conforming, such as California. For purposes of like 174, California didn't conform to TCJA, so therefore when you're actually calculating federal taxable income in 25 and 26 for the impacts of OB3, you'll need to adjust your California starting point number because those expenses will have already been taken. State conformity changes to 163J will depend upon how the states have reacted to the code and how they've actually treated 163J. For example, although Virginia is a rolling conformity state, right, they do have provisions in their conformity that tie to fiscal limitations and therefore may limit the timing of when OB3 is applicable. Once it is applicable for purposes of Virginia, we'd have to think about the implications of the adjustment they had for state purposes around 163J, because you have already taken some of that interest expense that was otherwise limited. Third, new code sections and subsections are going to create state tax complexities, even in states that have addressed the federal changes to TCJA. For example, the law adopts a new IRC 168, which extends 100% bonus depreciation to qualified production property. While many states have historically decoupled or modified for bonus depreciation under Section 168K, most states will need to address the new 168N depreciation allowance separately and consider the implications for encouraging in-state manufacturing activity. Likewise, the provisions for deducting R&D expenditures under the new 174A will raise state conformity questions, including in states that have already addressed Section 174 and may provide state-specific R&D expensing provisions. Businesses should analyze state conformity to the provisions in the federal reconciliation bill that may impact state 2025 estimate payments, as well as a potential reporting implication for financial statement purposes. Businesses should also monitor state legislation actions and administrative guidance on these new provisions and law changes, including potential action in special legislative sessions. Modeling these tax changes on a multi-state basis will be key to understanding the implications on businesses' effective rates and making informed business decisions. For more details, please read the linked insight. Thanks for watching. This has been PwC's Tax Insight in Brief.